Hello, welcome to LCG's preview for the week ahead. So it's the end of the first quarter of 2018. It's been a fairly tumultuous one, so we'll be looking forward to what's happening in the second quarter. Also have a look at the ongoing weakness in the technology sector, give it a bit of an outlook for gold, and also offer some preview for Friday's non-farm payrolls report. Before that, I'll run down the top corporate results to watch this week. So on Tuesday, we have Interserve and Ford Motors. On Wednesday, Acuity Brands and Lennar Corp. On Thursday, Hammerson and Monsanto. And then on Friday, we have Ladbrokes Coral and Norwegian Air. Now moving on to the economic calendar. It's Easter Monday, so there's no UK or European data, but there is the Tankan survey from Japan and also the US ISM manufacturing. On Tuesday, it's German retail sales and Eurozone and UK manufacturing PMIs. On Wednesday, it's Eurozone CPI and unemployment, US ADP unemployment and US ISM non-manufacturing, as well as US factory orders. On Thursday, it's services and composite PMIs from across Europe, Eurozone retail sales and the latest US trade balance. And then finally on Friday, it's the US non-farm payrolls, as well as unemployment data from Canada. So then thinking about this quarter that's just gone by and what might be in store for the second quarter of 2018, it's obviously been a pretty rough quarter. We had a massive run up in January, and then we obviously had the huge crash in February, March. A lot of the time was spent moving up and down within that range of February's crash. So we yet to really find a direction. So probably in Q2 will be whether we know when we know whether this correction extends into full bear market territory. So we've roughly seen a 12% pullback from the highs and a lot of these benchmark indices. If we're going to extend another 8% through the lows, obviously that takes us into a bear market for stocks. Obviously very much against consensus calls at the start of the year, but if you do look at some of these stock charts, which of course we do on the Monday webinar, you can see that we're well above some of the kind of typical averages and a sort of median trend for a lot of these stock markets. We rocketed higher, especially in US stocks, and Joe, technically, a correction's been long overdue for a while, and that's why I think the odds of an extension into a bear market, even in Q2, are pretty good. Obviously, you've got this talk of a trade war. I think even if talk of a trade war dies down, a lot of technology stocks have lost their they've lost their allure, and it was those FANG, those Facebooks, the Apples, the Amazons that were really driving the push forward in markets. And so if they continue to underperform, I think the market as a whole probably will as well. About that technology, obviously initially a lot of this is profit taking, so there's a bit of a kind of a mishmash here. If the market suddenly sees a spike in volatility, some of the best performing stocks naturally are going to underperform in that pullback as well. Typically what you see is stocks that have previously outperformed, they are the stocks that see the heaviest profit taking, and so often they see some of the biggest declines. And so a lot of these stocks are priced to perfection. We've had a bit of news from various different companies, or at least industries that affect these companies, which slightly takes the edge off their future. For me, a lot of these technology companies, you're buying into future industry trends. So obviously autonomous vehicles, electronic vehicles in the case of Tesla, online shopping in the case of Amazon, the use of smartphones, etc. with Apple. All of them have good business case, but if you look at how far the stocks have pushed up, it's you have to call into question whether all these companies are in fact going to be the ones that lead these industries higher, or are there going to be reasons for problems. And so, the death of somebody from an autonomous driving vehicle sets that industry back somewhat, probably is going to induce stronger regulation. Facebook and the way it's treated its users' data was obviously calls into question privacy, which has obviously always been an issue, but now it's very much at the forefront of everyone's minds. And governments, always a bit slow to the cause, are probably going to react now with some stronger cross-border regulation on the way information flows out of these social media companies. And so, put all this together, at the end of the week, we had some news from Donald Trump that he was looking to go after Amazon for its, typically fairly aggressive tax policy, and the fact that, when you talk about the high street going out of business and retailers struggling, always in the same conversation, you have to talk about Amazon. But is it really fair that all the high street's being put out of business when Amazon barely turns a profit? Really that's being propped up by stock markets and the low interest rate environment and the desire for growth stocks, and obviously playing into these future industry trends. And so some of that has room to be undone. Switching gears now somewhat to gold. Now, obviously, gold often a popular one to trade when you're talking about the non-farm payrolls reports. We do have that at the end of the week. I'll talk about that in just a minute. But for gold, I just wanted to say, and again, I'm going to show a chart here, which is a bit of a sneak preview for our quarterly report, which is a little fundamental and technical synopsis of where we think various popular markets are for the quarter ahead. Gold is one of the more interesting ones because it's sitting just below. It's broken a long-term downtrend line, and now it's just retesting the underside of another slightly flatter long-term trend line. If it is able to break out through these levels, we may have seen the basing out of gold that we've seen over the last couple of years finally come to an end, and a new bull market kick in for gold. So, it's an important level. Obviously, it could fail and we could see weakness in gold this year, particularly if stock markets bounce back. But I think, given that what we can probably expect is more nervousness from investors, potentially a bear market in stocks, that's all generally pretty good for gold, which is the classic safe haven investment. Gold definitely does react to the US dollar, and we expect the dollar to be reacting to non-farm payrolls on Friday. Just to give you the numbers here, we're expecting 0.2% in average earnings growth month over month versus 0.1%. You remember that was a disappointment last month. So we're talking about the March data here, obviously. We're expecting 185,000 jobs. That's against last month's 313K, so obviously that's a bit of a downturn. Now, that 313 was a big surprise to the upside, so obviously possibility of that happening again in March. Unemployment rate, we're expecting to tick back down to 4% from 4.1% last time. So it's interesting from the prospect of, we obviously had this unemployment report which caused that kind of triggered, if you like, the downturn in February and the spike in volatility. So we're looking for any reaction similar to that again in this report. We're 2 months down the road from that now. But it's also interesting because the dollar has flatlined somewhat recently against the yen. It was falling, but against the pound and the euro, it's been steady beneath these yearly highs. And so if we do see more strong data, especially on the back of some pretty decent inflation readings for March, which we saw at the tail end of last week, then actually this will bode quite well for a bit of a bounce back in the dollar. Something we talked about in a couple of weeks ago, but we've still stayed in the range since then. So we're still eyeing the possibility of basically a top in the euro dollar and a top in cable. Right, thank you very much for watching this week's video. Hope that was informative. Please, if you do find these videos interesting, sign up and register on social media, YouTube, Facebook and Twitter, and catch these videos just as they come out.